Good morning and hello and welcome back. If you're joining the live or watching the replay, I am Betty Rose Pradhan, founder of BBITS. I am a bookkeeping and accounting owner. And on day one, we talked about why January matters. On day two, we talked about closing your books. Today, we're covering one of the most important steps that business owners skip or misunderstand: bank and credit card reconciliations. This one step can make or break your tax return. What reconciliation actually means? Let's start with the basics. Reconciling an account means your bookkeeping system matches your actual bank or credit card statement. Not closed, not estimated, matched exactly. If your books say you have $5,000, but your bank says 4,200, something is wrong. And that difference always matters. Reconciliation is proof your numbers are real. If you've ever said, QuickBooks says one thing, but my bank says another, type me in the comments. You're not alone. Why receipts are not enough? Receipts are helpful, but receipts alone are not bookkeeping. Here's why. They don't show deposits, they don't show refunds, they don't show fees, and they don't show timing issues. Your bank statement shows what actually happened. Reconciliation confirms income wasn't missed, expenses weren't duplicated, transactions weren't deleted, nothing extra was added. The IRS trusts bank accounts, not guesses, not receipts in a shoebox. What happens when you don't reconcile? When accounts aren't reconciled, I often see duplicate transactions, missing income, incorrect balances, negative accounts that shouldn't be negative, owner draws recorded incorrectly. This leads to wrong profit, wrong tax liability, delayed filings, and IRS notices. If December isn't reconciled, your year isn't done. Be honest. Type yes if you reconcile monthly. Type no if you don't. Both answers are okay. Now, bank versus credit card reconciliation. Let's clarify the difference. Bank reconciliation, this confirms deposits, withdrawals, transfers, ending cash balance. Credit card reconciliation, this confirms charges, payments, fees, ending balance owed. Credit cards are not expenses, they are liabilities. Only the charges are expenses. This is where many books go wrong. Common reconciliation mistakes. Here are mistakes I see every January: skipping months, reconciling only the bank, not the cards, clearing transactions without checking, forcing balances to match, ignoring old discrepancies. Reconciliation should explain differences, not hide them. Accuracy matters. How often you should reconcile, you ask? At minimum, monthly for all accounts. If you have high transaction volume, multiple accounts, cash apps, you may need weekly reviews. Reconciliation is maintenance, not a once a year task. Who needs help with reconciliation? If you avoid looking at balances, don't trust your reports, have unexplained differences, are behind multiple months. You're not failing, you're overwhelmed, and that's fixable. At BBITS, reconciliation is a non-negotiable step. In every cleanup and monthly service, we don't guess, we verify. That's how books stay clean and tax prep stays smooth. If your bank or credit card balances don't match, Pause before filing taxes. DM me RECON or book a discovery call and use the link in my bio. Clean books start with reconciliations. Tomorrow, we'll talk about expense categorization and why guessing costs you money. Thank you for being here, and I'll see you tomorrow. Again, so check our website at bettysbookkeeping.com and our Instagram, BBITS_New York Tax. Again, see you tomorrow.